You don't have to have a heap of experience. You don't have to have a heap of money. You don't have to know everything there is to know about investing to start. Starting early is the best medicine for growing your money.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to the Young Minds podcast, hosted by Burke, Britton Financial Partners. I'm Bridie.
I'm Daniel.
And this podcast helps young adults build confidence and clarity when it comes to money, empowered by youth, inspired by experience. We know that navigating the world of finance in your late teens to 20s can feel overwhelming, whether it's understanding your first payslip, learning how to invest, managing student debt, or just trying to save without missing out on life, because believe it or not, it is actually possible.
That's why this podcast is here, to make finance more accessible, more understandable, and way more relevant to your life right now. Each episode will break down key financial concepts, give you the practical tips you can actually use, and have some real conversations about money. From budgeting and credit scores to purchasing your first home, we'll cover it all.
As university students coming to the end of our degrees, we created this podcast not because we have all the answers, but because we're asking the same questions you are. Each episode will be accompanied by a qualified financial advisor from the Burke Britton Financial Partner practice to provide insight and guidance in the topics to come. No confusing words, no lectures, just honest insight to help you make smarter money moves now and in the future.
So whether you're studying, working, or figuring things out, you're in the right place. Accompanying us again today is Jay. Welcome back, Jay.
Thank you, Daniel. Happy birthday for yesterday.
Thank you.
Thanks, Bridie. Thanks for having me.
Yes.
So today's podcast is all about investing. So we thought, just to kickstart it off, if you wanted to just maybe explain what investing is, just in a general sense, in simple terms.
Well, I think I hinted at this in our last podcast, which I think was the first around budgeting and cash flow management. I was excited about drawing the parallel between managing cash flow and investing. Listen, investing is essentially having your money grow over time, like committing some of your money somewhere with the expectation that it's going to grow in value. And that's assuming that we're talking about investing when we speak about money. I had a question for you guys. Like, when you think about where money comes from, this is maybe going back to like really first principles. Growing up, where did you think money came from, Bridie?
First thought is employment, like your first job.
I thought you were going to say mum and dad. That's what my kids would say.
Yeah, that too.
Daniel?
Yeah, it was the same. Just growing up, it was always, get a job, earn some money. It was no real other thoughts other than that.
Yeah, and why I asked that question, and I'm glad that that was a response that you got, is that most of us are conditioned when we're growing up that we exchange time, so our labour, for money. So to get money in our bank account, which is the first investment, I suppose, that we think about, the way we do that is exchange our time for money. And it's not until people start to ask the questions that the two of you are asking on this podcast that you think that there's actually other ways to get money. And you'll hear people talk about putting your money to work rather than you to work. That, to me, is that concept of investing. Investing is where we exchange, rather than exchanging time for money, we exchange money for money. So we invest some of our money, maybe that we've accumulated through employment, through work, and we put that to work with the intention that it's actually going to grow in value. So that's my definition, if you like, of investing. I know there's probably better Webster definitions of investing, but that's how I think about it in the context of money.
Mm-hmm, mm-hmm. And in terms of exchanging money for money, where do you do that?
Well, this is where the universe starts to open up, isn't it? Like most of us, when you think about if you think about investing, like most people, when you say investing, well, I'll ask you again, I'll turn this back to you guys. When I say investing, what's the first thing that comes to mind? Just first three words that come to mind.
You need a lot of money to do it.
Need a lot of money. Yep. Bridie?
It's on the stock market. That's where my brain goes.
Stock market. Yep.
Yeah. Just, you do it when you're a little bit older, once you're a bit more established, that sort of stuff.
You've got to have experience to do it. You've got to have money to do it. It's probably the stock market. Yep. Mm-hmm. Anything else?
Shares.
Yep. Do you think does investing conjure up ideas of safety or risk or
risk? Definitely risk.
Okay.
Yeah.
Yep. So when we think about investing is exchanging some of your money with the hope that it's actually going to grow over time. And most of us, when we grow up, again, we're talking to people of your ilk that are starting to understand about investing. Most of the time, people have a few things in mind about investing. They'll think cash, so earn money, maybe not folding cash, Daniel, like you got for your birthday, but they'll think cash in the bank. They'll see properties around and they'll hear that their family or friends have invested in property. And if they are speaking to people that way inclined, they might understand that shares might be another way of investing. They're the most common thought of investments. And traditionally, that's what people invest in: cash, property, and shares. But the universe of investments is very broad. And as financial advisors, without getting too bogged down, there is a spectrum of investments everywhere from cash, bonds, fixed interest, property, both residential, commercial, currencies, commodities, shares, both Australian, international, small companies, big companies. So the universe of investments is huge, and that's why most people just get too overwhelmed with it, and they think this is too hard. The barrier to entry to actually understand how to invest is too big, and therefore they do nothing, which is the encouragement of people listening to this podcast is to say, and I'm probably jumping to the closing argument here, that is, you don't have to have a heap of experience. You don't have to have a heap of money. You don't have to know everything there is to know about investing to start. Starting early is the best medicine for growing your money.
Well, that leads to my next question. Like, when is the right time to start? Like, is it when you have a little bit more money? Can you start, a common misconception was that, like I said, you have to start when you're a little bit older, but can you start younger? And if so, how do you start younger? Like, what's a good way to go about it to get you into the habit of investing?
You think about any of the decisions that we make in life, they tend to come attached to a milestone. So it's when you get your first job, you think, oh, I've got a bit more money. What could I do with it? That tends to be a bit of an impetus for people to invest. You receive you receive a handful of cash from your grandparents at your birthday, and you think, oh, that's great. I've got some funds. Maybe I should invest. You receive an inheritance. A lot of those are triggers for people to start to think about investing. But your point is spot on, Daniel, and it flows on from what I just said, that you don't actually need to have a lot of money. It doesn't need to be at your first job. It doesn't need to be when you receive an inheritance. It doesn't need to be at some point in the distant future. You can start today with very small amounts, and that's unique to this time we're in today. It used to be that the barrier entry to investing was much harder. You had to have a stockbroker, or you had to have a minimum amount to invest. You had to have a reasonable amount of experience. Those days are gone, but people still will err on the side of caution and maybe not invest because they don't know where to start. So to the answer of where people can actually go to invest, there is a multitude now of platforms. Like the technology age has allowed people to invest what we call sort of micro investments. Gone is the day when you had to have a couple of $1,000s to invest in what we call a managed fund. Today, you can invest with as little as 20 cents, with $1, with $20, and still get exposure to some of those investments, those asset classes that I spoke about earlier.
Yep. The next one we had was, why do people invest? So we've got, what's your reasoning? What do you want out of it? Is it growth? Is it income? What's people's reason?
It's another great question. It's one I feel like I'm going to keep flipping this question to the people that want to know the answer. But if I've got to answer this myself, why do people invest? The idea of investing, that people have some sort of a goal or a milestone that they're trying to achieve. And I said this on previous podcasts, that financial planning's and money's a means to an end. Money is a means to a lifestyle end. And so most people have an idea of something that they want to achieve in their life. It might be that they want to own a home, they want to travel overseas, they want to start a business, they want to start a family. Each of those milestones, those lifestyle objectives, generally has like a monetary value attached to it. And so we have to achieve that monetary value to allow us to go on that whole overseas trip, start that business, buy our first home, have enough money to be able to start a family. So they tend to be the things that sort of prompt people to want to invest. But Daniel, you've heard me say this, and probably you as well, Bridie, in client appointments. If I had to kind of boil down what we're trying to do when we are investing, in simple terms, we are trying to get to the point, and this goes to the point of putting your money to work rather than you to work. We want to get to the point sooner rather than later in life where if we are working, so if we're exchanging time for money, we're going and we have a job, that we're doing that because we choose to, not because we're financially burdened to have to. And so what we want to do in life is get to the point sooner rather than later where if you're working, it's because you choose to, not because you have to. How do you do that? Well, you have to have income come from some other source. You have to have money come from some other source. How do you do that? You have to have a pool of investments that give you a passive income. So people hear this idea of passive income when you go, what's passive income? Passive income largely is income that you don't have to work for. It's income that comes from your investments that you have put to work, investing in shares, property, fixed interest, bonds, cash, whatever it might be, a small business. It's putting your money to work so that you don't have to. Does that make sense?
Yeah.
Now, getting into risk versus reward. So now it's determining, you're going to invest, but there's different ways to invest based off of, how much risk you want to take. So I guess going into that, like, how would you determine, do you think, your risk tolerance? Like, what would you think about that?
Now, you said at the beginning, Daniel, that one of your intros was no confusing words. And I would argue that when you say risk tolerance, most people that listen to this would go, what does that actually mean? Like and I know we use this like risk tolerance, risk profile, risk versus reward. Just quickly, when you say risk, what does risk mean?
So just risk means, like, say you want to invest a certain amount of money. How much of that money do you want in, growth assets that are going to grow over time? And how much do you want on the side as a bit of a defensive, if the worst comes to worst, you can fall back on that?
So with growth assets, what's inherent, when we talk risk, what's inherent with growth assets?
Could be shares, stocks, anything that can be invested with a vision that value is going to grow over time.
With growth, what else comes with growth? So with the potential for something to grow over time, what's the other potential for something?
High risk, doesn't it?
Yeah. And so what does high risk mean? So if, in your words, Bridie, what does risk look like?
It's a higher chance of losing what you've invested.
Great. Yeah. So when we start to think about risk versus return or risk reward, we start to think about how much risk am I prepared to take to get the reward of a greater rate of return. And your point, Daniel, is spot on. When you start to think about growth assets, and again, you're already starting to use the language of a financial advisor, like the growth assets are things that we know historically will grow greater, like they have a greater potential for giving us a better rate of return. But with that comes an inherent risk that there's also a downside. So, the spectrum of investments that I spoke about earlier, we can invest, when we start to look about the universe of investments, we go everywhere from money in the bank, so cash and term deposits, fixed interest, property, Australian shares, international shares. As you go up that scale, history tells us that the left-hand side, if I'm using my left hand, I think that's going to come across on the camera. From the left-hand side, cash is considered safe and secure and conservative. Shares on the other end are considered high risk, more speculative. So if we think about risk versus return, we have to be very cautious about the time frame that we're investing. If we want to invest in shares because we want a better rate of return, we have to accept the fact that they'll be risky, but over the long term, they will, well, history tells us that those more risky assets perform much better over time. Now, in preparation for the podcast, I actually I was interested in what the actual rate of return of I figured you'd ask me this question because you gave me a list of questions beforehand, but I thought, listen, over the last 20 years, what has been the sort of average rate of return for those asset classes I talked about? So over the last 20 years, cash, and again, someone can correct me in the notes if they like here, but this is, we got this off the web. So cash on average over the last 20 years has returned 3.8%. Property in Australia on average over time, over the last 20 years, has returned 5.2%. Australian shares over the last 20 years have returned 8.3%. and international shares have returned nearly 12%, 11.7%. So you can see the difference over time from cash that is reasonably conservative. We know if you put money in the bank, your money in the bank is your money in the bank. It doesn't go backwards, it earns interest, but it is safe and secure. That's what people consider to be conservative. At the other end of the spectrum, you've got things like shares that have the potential over time to give a much greater return, but they come with a much greater degree of risk. Does that make sense?
Mm-hmm.
Yep.
Mm-hmm. We keep having this common theme of time come up. We've got here that time is your greatest asset in investing. Why is that?
Well, there's an analogy or a sort of play on words that has been used for my time in financial planning, and that says time in the market versus timing the market. So this concept of your best friend when it comes to investing is time. And to my example earlier of the different rates of return that the history tells us the market gives us, I did another little a little working paper in readiness for this. I said, let's assume that you had $50 a week, and you weren't going to put $50 a week into an investment. So you're going to invest $50 a week over 20 years, and you had a choice of putting $50 into cash, so in the bank. Like I said before, cash earning on average 3.8% over the last 20 years. Let me use the other end of the spectrum, which was international shares returning nearly 12% over the last 20 years. So $50 a week over 20 years is $52,000 invested over 20 years. If you put that $52,000 or $50 a week into cash, your end result is $78,718.
Mm-hmm.
If you put that money into international shares over the last 20 years, that $52,000 becomes $202,114. So it's $50 a week, every week for 20 years. That's the difference of investing over time and the benefit of compounding over time. So the magic of compounding is an amazing, it's an amazing thing. Compounding where your money, your interest continues to grow. So you have growth on growth on growth. It's like a snowball that over time continues to sort of pick up speed, grow in size, and just starts to run on its own momentum. That's the value of time. And to the point I mentioned earlier about time in the market versus timing the market, everyone is going to be bombarded with noise and news about the next greatest investment. It's going to be crypto. It's going to be NFTs were huge there for a while, non-fungible tokens. And people have a sense that I'm better to jump in and out of the next hot investment all the time. We're going to jump from one thing to another and try to time the market. Evidence and history would tell us that that's a bad idea. Trying to pick what investment you should be jumping in and out of every 5 minutes is far outweighed by simply being super consistent and investing small amounts regularly over a long period of time. And it also saves you a lot of headspace because you don't have to worry about what's happening in those particular markets. It's important, like part of the idea of investing is making sure that you do educate yourself. I've mentioned right at the beginning that investing in the context of money is taking some of your money and investing it and trying to grow it. But I think about investing also in different terms from investing in yourself. Like part of the idea of being a financial advisor is to encourage people to invest in their own education about money, understanding markets, and therefore being much more comfortable with their decisions. I think you combine those two together, investing just in money in general and doing it over time, combined with educating yourself by listening to Daniel and Bridie on their podcast, you will be unstoppable.
I guess one thing that people might not know, including myself, especially when I first started here, was, tools to use to invest. So most people would have heard that you can invest. Maybe they would have heard about a couple shares here and there. And maybe some people would have heard that when you're investing, you should invest in this share. It's really good. But then there's the conception that you have to invest in that share and you have to control it all the time. And you can only maybe invest in 2 or 3 sort of shares, I guess. So maybe if you could just touch on some tools to invest, like a managed fund, like maybe just explaining what a managed fund is and how people can use that sort of stuff to be able to invest.
Yeah. And this is a great flow on from that previous question, which is the importance of understanding and educating yourself. I love people who want to understand individual stocks and shares and have a particular interest and passion, but it's not everyone. Not everyone can be researching every stock on the Australian or international exchange. And so there needs to be another mechanism for people to be able to invest simply without a heap of knowledge and understanding, but also not put themselves at risk of just investing in one stock. We haven't talked about diversification yet, but the risk, there is an inherent risk in putting all of your money into just one asset, one stock, one share, one property. The idea of not having all of your eggs in one basket. The universe of how you invest. So you asked about managed funds. So managed funds, think about a managed fund as something that is all your mates together. You combine all of your money together and you get someone who's got expertise in investing to do the investment and management for you. And you pay them a fee for doing that, for their expertise. So that's a managed fund. And traditionally, that is the way that people actually invested. If they didn't have a lot of experience, they didn't have a share broker, they would go and invest in a pooled investment called a managed fund. Managed funds historically were pretty clunky. So in my time, managed funds required a paper application. So they required a lot of paperwork. They required a minimum investment. That minimum investment could be $5,000, $10,000, $15,000. So the barrier to entry was difficult. Of recent time, I mean in the last decade, there has been the introduction of things they call ETFs. So ETFs are a thing called an exchange-traded fund. So the way people have traditionally invested in the stock market and investing, or let me go back to share investing. Share investing or stock market investing is where you invest a small amount to take a small interest in a company that's listed on the stock exchange. Around the world, exchanges were created to allow people to exchange money for an interest in a company and therefore invest. Managed funds weren't available on the stock exchange. So some clever people with the use of technology put their managed funds that you could only invest in with paper. They put them on the exchange. And so it's the equivalent of having a managed fund that previously would have a minimum of investment of $5,000. Now you can trade it on the stock exchange, and you can trade it every day between 10 and 4 on the Australian Stock Exchange. You can buy ETFs to your heart's content and get all that expertise of someone managing your money for you, but do it at a very low cost and with a very small amount. What else do we have in terms of we have things like index investments. So we start to see some of these different investments are kind of blends of the same thing. So an index investment is similar to an ETF could be in fact an index investment, but most people come when they come in to see us, they've got some experience. They'll say, I want to invest in a Vanguard index fund. It's the most commonly thought about investment that people, if they've got a lot of experience, it's the most well marketed form of investment that most people have if they want to invest simply. And the index, so every night when you look on the news, there is, they'll talk about the All Ordinaries or the ASX 200. Most people think about that as the share market, and index investments basically allow you to invest in, with very simple terms, allow you to invest in like the top 100 Australian shares. And so it's what we call sort of a passive investment. So there's not someone in there making changes like a managed fund where they're moving shares in and out. You literally just own the top 100 shares, for example, in Australia or in the US. And if they go up, your money goes up. If they go down, your money goes down. And that is what we consider to be index investing. Any other platforms that come to mind for the two of you that you've heard about or thought about when it comes to tools to invest?
We haven't really touched on, there's CommBank. You can invest through CommSec and get shares through your banks and stuff. And there's also, we haven't touched on crypto yet.
Yep.
There's a couple of different platforms you can use with crypto, but yeah, they're the first two that come to mind.
Yeah, so when we start to think about like CommSec is a trading platform, and CommSec it's probably another example of technology, right? So previously, if you wanted to invest in the share market, you had to have a broker, right? There was brokers you had to literally pick up the phone and say, hey, I want to buy some Commonwealth Bank or some BHP shares, and they would transact. It'd be an exchange, and that you transfer them some money. You'd probably have to fax them or something like that, a check. We send them a check to exchange and buy some shares. Now, with technology and mobile apps, you can, with the likes of CommSec or NabTrade, you can, at very low cost, buy shares yourself from your phone. So CommSec, NabTrade, there's a bunch of others, are literally trading platforms that allow you to invest a small amount into companies. Now, with the advance of crypto, so cryptocurrencies and Bitcoin, Ethereum, those types of things, exchanges like the stock exchange have been created to trade cryptocurrencies. And similarly, there have been apps like CommSec, NabTrade, that allow you to very simply jump on and buy little bits of each of those assets. Like most assets, we said, I probably didn't mention crypto in that spectrum of investments, from really conservative investments to quite speculative investments, risky investments. Crypto probably sits at the moment, I'd argue, probably sits at the very top end of high risk, but of recent time, high return.
Mm-hmm.
Now, when it comes to obviously the investing, and it's very easy now, it's becoming more and more accessible to invest and easier and all of that. Now, obviously, there's the effect of, if you do over time make a profit off of investing, you can't just sell it and whatever you have, you get. There's a bit of a capital gains tax that will be involved at some stage. If you could just maybe touch on what the capital gains, how it works.
Sure. So we probably should always preface this with saying that capital gains, like any idea of tax applying to the sale of shares, it depends on people's individual circumstances. But in really simple terms, what are we trying to do when we're investing? What do you want to happen when you invest? Do you want your money to go up, or do you want your money to go down?
Go up.
You want it to go up. Okay. So when your money goes up, the capital that you've invested, the hope is that you have a gain. That's called a capital gain. Now, the government, after about 1986, they want to generate a little bit more revenue, and so they decided that there was people making too much money on shares and property. They introduced what they called capital gains tax. Basically, capital gains tax is where, if you have growth in your investment, so let's say you invest $1,000 in some shares, and those shares grow to $2,000, you've had a gain of $1,000. You potentially, depending on your circumstances, have to declare that gain to the taxman. You have to say to the taxman, I've made $1,000 on these shares, and depending on how long you've held them for and your other financial situation, other tax circumstances, the potential is that you'll pay some tax on that gain. What I'd encourage people to do when they think about that is to recognize that a capital gain, or your investments growing, is actually what you want to happen. And if, as a consequence of that, we have to manage some tax, and maybe we'll do another episode where we talk about how you actually manage tax, but it's not a problem. Like, having investments that grow in value is what we want to happen. And as we start to get more sophisticated in investing, there's not only ways to minimize tax, there's different ways to hold your investments to help minimize tax. And that is why people come to see financial advisors. But when you're starting out as an investor, when you're starting out very early on, I think the last thing you need to be concerning yourself is capital gains tax. I would say it's something to learn about, but as you become more sophisticated in your investments, you'll actually get support and understanding around how you manage it.
Do you want to give us just sort of like a overall summary of like what you find are the key points of what we've discussed today?
Yeah. So I think I probably mentioned it right at the outset, and that is there's never the best time to invest. Well, if you haven't already started, the next best time is today. You don't have to have a lot of money to invest. You can have a very small amount, and you can do so with some pretty simple tools that are available online. I don't think we mentioned some of the platforms, but you don't have to look far to see apps like Raise and Starship and CoinSpot and ComSec and NabTrade, all which give the ability for people to actually invest small amounts regularly. So the barrier to entry is very low. The only thing that's probably stopping you from investing is a little bit of experience. So getting a little bit of experience on what you should actually be investing in and starting. Once you've started, the idea is to be disciplined and be consistent. So small amounts regularly over a long period of time are super important. To Daniel's point, make sure you've got an understanding of your time frame. So if you think you're going to need this money in the short term, so don't put it at risk. So if you think you're going to need money for a car or a holiday or to pay off your HEX debt in the very short term, probably shouldn't put it into the share market. But if you've thought through all of that and you can commit some money long term, then don't be scared about investing. Get in, get after it, look after your cash flow, and invest small amounts regularly, and you'll do particularly well for yourself.
Thank you. Thank you very much.
I think that's all we got for today. So thank you very much, Jay, for joining us and sharing your expertise. And we'll see you next time.
Thanks, guys. Well done.
Thank you.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PP Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.